I'm James Wagner for Professor It, and as always, we're going to start off with a question. And the question is, how much money do you need when you enter retirement? Well, according to financial planning experts, most people don't have a clue, with only about 1/3 of Americans having even tried to calculate this amount. Don't make this mistake with your retirement planning. To avoid financial worries, you should make sure you have enough money saved when you retire. Calculating this amount is a real project, so don't take it lightly. A variety of factors will affect your answer, and inaccurate estimates for any factor can leave you with little or no extra savings. Some of the more significant factors provided to us by the AARP include: what percentage of your pre-retirement income will you need? You can find various rules of thumb indicating you'll need anywhere from, say, 60% to over 100% of your pre-retirement income. On the surface, it seems like you should need less than 100% of your income. After all, you don't have any work-related expenses such as clothing, lunches, or even commuting expenses. But look carefully at your current expenses and how you plan on spending your retirement before deciding how much you'll need. If you pay off your mortgage, stay in good health, live in a city with low cost of living, and engage in inexpensive hobbies, then you might get by with less than 100% of your income. However, if you travel extensively, pay for health insurance, and maintain significant debt levels, then even 100% of your income may not be enough. You need to take a close look at your expenses and planned retirement activities to come up with a reasonable estimate. When will you retire? When your retirement determines how long you will save and how long your investment returns can compound. Most people would like to take retirement before age 65, but that typically requires significant personal savings. You want to be sure your retirement savings and other income sources, such as Social Security, pension benefits, and so forth, will support you for what could be a very lengthy retirement. Even reducing your retirement age by a couple of years can significantly affect the ultimate amount you need. How long will you live? Oh, that's a toughie. Most people look at the average life expectancies when estimating this. But an average life expectancy means you have a 50% chance of living beyond that age and a 50% chance of dying before that age. Since you can't be sure which will apply to you, it's typically better to assume that you will live at least 5 years past that age. When deciding how many years to add, consider your health as well as how long other family members have lived. What long-term rate of return do you expect on your earned investments? A few years ago, many retirement plans were calculated using fairly high rates of return. Those high returns don't look so assured now, though, do they? At a minimum, make sure your expectations are based on an average returns over a very long period of time. You might even want to make more conservative, assuming a rate of, let's say, lower than long-term averages suggest. Even a small difference in your estimated and actual rate of return can make a big difference in your ultimate savings. For example, assume you estimate a long-term rate of return of 9%. Okay, so if you save $5,000 per year in a tax-deferred account for 25 years at 9%, you will have exactly, get ready, $461,620 before paying any income taxes that may be due. I know some of you are out there calculating, so check me on that one. However, if your actual return is 8% rather than 9%, you will have only $394,772, a difference of $66,848. That's a big difference. And what about inflation? Keep in mind that even modest levels of inflation can impact purchasing power of your money in the future. Here's another example. For instance, if after 30 years of just 2% inflation, your portfolio's purchasing power will decline by 45%. That's big. When estimating an inflation figure, don't just look at historically low inflation rates from the recent past. Also, consider long-term inflation rates, since your retirement will hopefully last for several happy decades. What tax rate will you pay on retirement, especially on 401ks and IRAs? After you've considered these factors, you can calculate how much you will need for retirement. Chances are that unless you're a CPA or have spent a lot of time on this exercise, you will want to consult a financial planning or estate planning expert. Okay, let's move over to just that, estate planning, getting ready. Even if you have a formal estate plan, organizing your personal paperwork and informing heirs of basic decisions will make it easier for heirs to handle your estate after your death. Without an organized approach, your preferences for funeral arrangements may not be followed, friends or family may not be notified of your death, or items with sentimental value may not be properly passed on. Without organized financial records, your heirs may not locate all assets, with the possibility of stocks, bonds, bank accounts, real estate, or other insurance policy benefits. They may go unclaimed. One way to approach this task in a systematic manner is to prepare a personal letter of instructions covering the following topics. First of all, your assets and rationale for distribution. Now, this is a good place to explain why you distributed your estate in the manner you did. You can go into specific detail if you like, informing heirs how each asset will be distributed, or you can give a general overview of your estate plan. If you selected one heir as executor or trustee, explain why you chose that individual. List all assets and where important documents concerning those assets are located. Prepare a list of all checking and savings accounts, including the bank name, account numbers, and individuals on the account. Detail all insurance policies, including policy numbers, effective dates, levels of coverage, and policy locations. Also, list all outstanding debts. Next, individuals to contact. List names, addresses, and telephone numbers of individuals your heirs need to contact, including employers, attorneys, accountants, insurance agents, investment managers, and financial planners. Next, personal papers. Indicate where personal records are kept, including your birth certificate, marriage certificate, divorce records or separation agreements, diplomas, military records, and naturalization records. Next, safe deposit box. Indicate where the safe deposit box is located and what is contained in the box. Note where the key is kept and who has access to the box. Then we move to disposition of personal items. Detail how you would like your personal items distributed, including jewelry, photographs, personal collections, pets, and furniture. And funeral arrangements. Indicate your preference for funeral arrangements, including whether you want a religious or secular service, whether we want flowers or donations to charity, whether you want to donate your organs or body to medical institutions, and where you would like to be buried and how your remains should be disposed of. These are items your heirs may feel uncomfortable asking about, but will be grateful your wishes are known so that they can carry them out. Also, list any friends or family you would like contacted after your death. Your thoughts on these subjects can change over time, so review and update the letter periodically. Keep it in place where heirs can find it immediately after your death. Now, to ensure your estate is distributed to the intended heirs at a minimum estate tax cost, avoid these common estate planning mistakes. First, thinking estate planning is not needed to do the provisions of the Tax Act of 2001. It's true that the Estate Tax Act is scheduled to be repealed, but only for the year 2010. Until then, the amount you can distribute to heirs other than your spouse without paying estate taxes will increase from $2 million in 2006 to $3,500,000 in 2009. Estate taxes will be repealed in 2010, but reinstated again in 2011 based on the 2001 tax laws. Are you paying attention? That's a lot of numbers and a lot of dollars. Rather than eliminating the need for estate planning, the Tax Act has made it much more complex. Leave it to the government. Your estate planning strategies should encompass the possibility that you may die during these 3-year periods: the phase-out period, the year of the estate tax repeal, and after the reinstatement in 2011. Next, if that wasn't enough, next, believing that you don't need estate planning because your estate won't be subject to estate taxes. Even if your estate is less than the current exclusion of $2 million, there are other reasons to plan your estate. You probably still need a will to provide for your estate's distribution and to name a guardian for minor children. And you may also want to consider a durable power of attorney and a healthcare proxy. Next, relying solely on an unlimited marital deduction. With the unlimited marital deduction, you can leave all of your assets to your spouse without paying any estate taxes. However, if you have assets in excess of the exclusion amount, your heirs can't utilize that exclusion amount if you leave all your assets to your spouse. Check with your tax attorney first. I can see this is where we're going here. Thus, when your spouse dies, you may pay more estate taxes than if you had left some assets to them. Now, next, not implementing an annual gifting program. This is very popular with my sons, so I can tell you a lot about that. You can make an annual gift of up to $12,000 as of 2006. That's $24,000 if the gift is split with your spouse, to any number of individuals without paying any federal gift taxes whatsoever. Since the state tax repeal is only scheduled for 1 year, this strategy removes assets as well as any future appreciation or income generated from those gifts from your taxable estate. Over a number of years, an annual gifting program can remove substantial assets from your estate. And if you don't believe me, just ask my son. What you can believe from me, that as long as there's a shortage of money in the world, I will always have a family. Now, next up, failing to skip a generation on a tax-free basis. Leaving assets to children who already have substantial estates on their own means that assets will be taxed again when they are bequeathed to your grandchildren. A better strategy may be to transfer those assets directly to your grandchildren, although you can only transfer $2 million in 2006 before triggering an additional tax called the generation skipping transfer tax. And I hope all of us out here have this $2 million problem to confront, because that would be great. Now, forgetting that some assets bypass your will. Jointly owned property will transfer directly to the co-owner, while assets with named beneficiaries will transfer directly to those beneficiaries. Pay attention now. If you don't keep this in mind, some of your heirs could receive a larger percentage of your estate than you intended. Next up, you must update beneficiaries. Beneficiaries for assets such as life insurance policies, 401k plans, and individual retirement accounts should be reviewed after every major personal change like marriage, divorce, death, and birth. Owning an insurance policy on your own life, while life insurance proceeds are always free from federal income tax, owning the policy yourself will cause the proceeds to be included in the taxable estate that is yours, possibly subjecting them to additional estate taxes. Instead, you may want another individual or trust to own the policy so that it is excluded from your taxable estate. Well, I don't know about you, but I think we've exhausted this subject completely. But keep in mind, it's an area where the consequence of heirs can be extremely costly, given the steeply ascending nature of the estate tax laws. I hope that you've benefited from our visit and that you'll revisit this episode whenever you have questions about retirement and estate planning issues. I'm James Wagner for Professor It. Thanks for joining us today.